right now, the markets are pricing in about a 65% chance of winning from the Electoral College for Trump right now. So he has about a 65% chance of winning. And if he wins, there's probably a 90% chance that he actually does follow through with that and puts it on the reserves. And if he does that, then all the other nations have to move and put Bitcoin on their books. So if that happens, when we look at where Bitcoin could be by next year, I mean, we could be certainly at the top end of that range, maybe in the, sounds insane, could be at the $300,000-$400,000 levels. Now, if Kamala wins, on the other hand, then obviously all of that I just talked about is off of the table. But that doesn't mean that Bitcoin dies. Bitcoin is a global asset. Regardless of what the US does, Bitcoin is going to continue going up. Bitcoin is there as a relief valve for the money printing, and as we both laid out already, that's not going to stop. No matter who the president is, that's going to continue. So I think if Kamala wins, we're on the much more probably conservative side of the projection, which might be in the $100,000 range by next year, maybe a little higher, 150,000. But if Trump wins, I think we could be at the top end of that range, which again would be, somewhere in that $400,000 range.
Mark Moss begins by addressing a common misconception about Bitcoin's price trajectory. A year ago, many believed Bitcoin would hit $100,000, but Moss challenges that assumption by focusing on the driving forces behind such predictions. He emphasizes that instead of making assumptions, it's crucial to look at the data. The past year has been remarkable for Bitcoin, with a 130% increase in price since September 2023 and an even more impressive 242% rise since September 2022. While the S&P 500 might boast an 8% increase, Bitcoin's performance is unparalleled. Moss highlights that this isn't just a fluke. It's the result of broader economic factors, particularly global liquidity. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
If you would have asked me a year ago where I think things would have been, I might have said they should be at 100,000. But if you understand why would Bitcoin get to 100,000, what's the driver of that? And then you look at that instead of just this assumption I had made a year ago, I would say no. So if you asked me a year ago, I would have said yes. But when I look at the data behind it, I would say no, this is where we should be. And just to remind everybody here, again, zoom out. Over the last year, since September of 2023, we're up 130% in 1 year. Like, come on, guys. Like the S&P 500 is doing 8%. Like, get out of your own way here. 130% year over year. What about 2 years? Since September of 2022, we're up 242%. So again, you're going to drive yourself crazy looking at a monthly basis. Year over year, we're doing amazing. No other asset in the world is doing that. But so no, I'm not surprised. Now, again, what is the driver of this? Why does Bitcoin go up? And there's a lot of factors, but a large piece of that is this global liquidity. And so I had expected the liquidity to go up a little bit faster, but it didn't. So what we saw is that global liquidity, which is basically the amount of money in the system, actually started going down. So we saw right now we're breaking new all-time highs, but it ended in 2023 at about 171 trillion, but it hit its low in April. And it basically stayed from April all the way till about July at that low period before it started turning back up. So when you look at Bitcoin, sort of that, the choppiness that we've had and sort of in this range bound, it's been over the last 6 months, which is the same period of time that global liquidity hit that low and has remained in that range. Now it's turning back up. And if we look at past historical cycles, we see that Bitcoin sort of sits on about a 6-month lag. So it needs to gain that energy before that next burst takes off, which puts us right into, early next year. And again, right back on track. Every president in the first 3 years and 8 months of every single election cycle, the markets, the S&P 500, are up by about 50%. Every single president. Now,
Really?
there's certainly lots of social issues and lots of other issues, but in regards to markets, the first 3 years and 8 months from January when they take office to September, in the first 3 years and 8 months, they're up about 50%. So it doesn't really matter. Why is that? And that's going back to being on a debt-based monetary system that constantly has to expand, and it's the rising amount of liquidity in the system. Now, the thing to understand is that if you look at a lot of people on Twitter lately have been, Bitcoin real estate. And there's a lot of people saying that real estate is in a bubble, and real estate is way bigger of a bubble today than it was in 2008. Well, when you look at it in nominal terms, in US dollar terms, it looks that way. When you look at it adjusted for inflation, which is CPI, it looks that way. But when you adjust it for the rate of debasement, or just the even US M2, you'll see we're nowhere even close to where we were in 2008 prices. And so you start to see things differently. And so what you see is when the monetary system expands, true definition of inflation, where the liquidity goes up, it's pushing all these asset prices up, because it's not a bubble in real estate or the S&P 500 or Bitcoin. It's a bubble in the denominator. It's a bubble in the amount of money or liquidity in the system. Right. Now, the important thing to understand, taking it back to Bitcoin, is that different assets, so the rising tide rises all boats, so to speak, but different boats move at different rates. So what we see is there's different assets that have different sensitivities to the liquidity. So the S&P 500 is sort of like a perfect proxy in US median real estate as well. They move about at the same rate. But if we look at Bitcoin, it's much more sensitive. So it moves at about an 8.95 times sensitivity, whereas gold moves at about a 1.45 times sensitivity, which means for every 10% increase in liquidity, gold would go up by about 14% and Bitcoin would go up by 90%. Now, if we look at that, what does that tell us where we're now, and where does it tell us about where we're going? Well, luckily, the U.S. government, the CBO, projects where that debt will be going. And what we can see is that since 2019, the U.S. monetary base has been expanding by 10% per year.
Right.
And it's scheduled to continue that. I believe it'll accelerate. So if we're going up by 10% a year, Bitcoin's going up at about 90% of that, which is why, again, we're right on track. Right now, the markets are pricing in about a 65% chance of winning from the Electoral College for Trump right now. So he has about a 65% chance of winning. And if he wins, there's probably a 90% chance that he actually does follow through with that and puts it on the reserves. And if he does that, then all the other nations have to move and put Bitcoin on their books. So if that happens, when we look at where Bitcoin could be by next year, I mean, we could be certainly at the top end of that range, maybe in the, sounds insane, could be at the $300,000-$400,000 levels. Now, if Kamala wins, on the other hand, then obviously all of that I just talked about is off of the table. But that doesn't mean that Bitcoin dies. But Bitcoin is a global asset. Regardless of what the U.S. does, Bitcoin is going to continue going up. Bitcoin is there as a relief valve for the money printing. And as we've both laid out already, that's not going to stop. No matter who the president is, that's going to continue. So I think if Kamala wins, we're on the much more probably conservative side of the projection, which might be in the $100,000 range by next year, maybe a little higher, 150,000. But if Trump wins, I think we could be at the top end of that range, which again would be, somewhere in that $400,000 range.
Moss advises viewers not to drive themselves crazy by focusing on daily or even monthly price movements. Instead, he encourages a long-term perspective, noting that everything is going as expected since the Federal Reserve began tightening monetary policy in late 2021. Despite initial concerns that the Fed's actions would break the market, it's clear that at some point, rates will have to be lowered, continuing the cycle of monetary expansion. Moss emphasizes that this pattern is intrinsic to the debt-based monetary system, which always requires expansion to function.
People will drive themselves crazy when they're too zoomed in. And so you do have to zoom out. If you're looking at your portfolio on a daily, weekly, even monthly basis, you're going to go crazy. When you're looking at every single piece of news, trying to figure out what's tradable, I think you'll drive yourself crazy. So if we zoom out, I would say things are going right as planned, right as we all think they would. And what I mean by that is since the Fed announced they were going to start tightening in November of 2021, people thought they would break the market. We knew at some point they're going to have to lower rates. If you understand the financial system as a debt-based monetary system, you understand it always has to expand. Now, not always in a perfect straight line. So there are peaks and valleys, but we know what's going to happen. So they went on the tightening cycle, zooming into kind of where we're at right now. They start projecting that they were going to start lowering rates or regime shift from a tightening cycle to an easing cycle. And we could start to see it in the data. And so we could start to see beginning of this year, unemployment started ticking up, inflation started cooling down. They started pivoting towards that. All right. Now, Bitcoin hasn't been moving based off of this, but we know that they were going to do this. Jerome Powell has just been trying to hold this off as long as possible. But the proverbial rock in a hard place has been tightening on him because we've started to see the cracks, as I said, unemployment, et cetera, but also other governments, other central banks around the world. So other central banks have already started easing, but there's really 4 major central banks. And we'll get into liquidity because that's the big driver. But when I think about it, there's really 4 major central banks that we want to pay attention to. And the Federal Reserve, obviously, the ECB, the BOJ, and the PBOC. And in Europe, they already started easing, but Japan and China have been waiting. They're waiting for the U.S. because it needs to be somewhat coordinated. Of course, we saw, was it about a month ago, Japan tried to move in advance without the Fed, and that wreaked disaster for the markets. And so they said, okay, hang on, we'll wait for the Fed. And so now that the Fed has signaled that they're going to shift, we're expecting rate cuts, coming anytime now. It's 100%. The CME watch group is 100% chance that they're going to lower rates. The question is how far. Now China and the the BOJ can now start easing. So the whole world will start easing in unison, and we'll see that global liquidity start taking off again. So this is all working out sort of to plan. We also know that typically the summer is a bad time for markets. September is historically a bad time for markets. We have a hotly contested election cycle coming up as well. And so I think the volatility that we've been seeing is sort of to be expected. But just as planned, the liquidity cycles are about to pick back up. And I think we'll get right back on track. If you look back to October of 2022, I put a video on my channel, said there is no market crash coming, and here's why. In January, I made another video said that there's no crash coming. I said, here's the Fed's pivoting. Here's the data. I made another video that said it's time to buy. I'm buying now. In August of 2023, I made a video that the bear market's been canceled. And I've been making videos saying that what we're really expecting, or what I'm expecting, is a crash. I'm expecting a massive crash, and I'm expecting a really, really bad crash. But it's a much different crash than most people expect. You see, a crash, if you think about a crash, what's everybody afraid of? A recession, a market crash. What does that mean? Well, if things crash, let's say what most people think, my retirement portfolio drops, my real estate, my home drops, I lose my job, I get a lower paying job, my business doesn't do as well, I don't make as much money. That's what most people think of. But what does that mean? What all that means is that the quality of my life would go down. The standard of my living goes down. I don't have as much money. So I have to now eat hamburger meat instead of steak. So really what they're saying is a crash means my standard of living goes down. But you see, prices don't have to drop for that to happen. Prices could go up so fast that my pay doesn't keep up and my standard of living also goes down. So it's a reverse crash. And while everybody's expecting a deflationary crash, I'm expecting an inflationary crash. Now, the results are the same. We both have a standard of living that's been reduced. However, I think a reverse crash, an inflationary crash, is actually much worse. And the reason why it's much worse is because on a deflationary crash, at least the market's reset and people get a chance to get back in, right? My kids could eventually buy a house. But in an inflationary crash, you never get another chance. It's just too late. And so I think that's where we're going. Now, will there be crashes? I mean, what is your definition of that? Of course, there's going to be massive volatility along the way, but I don't expect any long sustained depression. Maybe we see some sort of flash crashes, sort of like we saw in 2020, that probably last half the time, something like that, not tradable events, because it's going to be volatile along the way. I mean, if you look at the chart of the Weimar inflation, hyperinflation, and I'm sure you've seen it, right, with the red lines overlaid, the volatility was insane. And so we'll have that, but I'm expecting the crash up.
Moss introduces the concept of an inflationary crash, which he believes is a far more dangerous scenario than the deflationary crash most people fear. While a deflationary crash would lower asset prices and provide opportunities for new buyers, an inflationary crash erodes purchasing power without providing a chance for recovery. In such a scenario, prices rise so quickly that wages can't keep up, leading to a decline in living standards. Moss warns that while volatility is expected, the inflationary pressures will likely continue, making it crucial to be prepared for the long-term effects of this economic shift. Please like and subscribe my channel.